The topic for this video is Module 4, Investment Instruments, Chapter 12, Alternative Investments, for the CFA Institute Investment Foundations Program. So here we are in Chapter 12 for Alternative Investment. It's the last chapter in Module 4, Investment Instruments. There's only 4 learning outcome statements, and as you can see in the learning ecosystem, there are only 30 practice questions, so it's a relatively easy chapter, and it's going to be a quick one. The 4 learning outcome statements for this chapter are Learning Outcome Statement A, describe advantages and limitations of alternative investments. B, describe private equity investments. C, describe real estate investments. And finally, D, describe commodity investments. So before we jump into the chapter, just going to start with one of my own slides just to give us a bit of a bigger picture again. So we've already done the chapter on debt securities, which is basically bonds, and we've done the chapter on equity securities, which is stocks. So I just want to point out that the traditional core portfolio and traditional asset classes are stocks, bonds, and cash, okay? If we look outside of the traditional core portfolio or the traditional asset classes, we sometimes refer to non-traditional asset classes, and non-traditional asset classes are alternative investments. So in this chapter, we're going to be looking at private equity, real estate, and commodities. And you can see I put real estate in just a slightly different shade, because if you're reading some chapters from different publishers, different texts, sometimes you will see real estate included in individuals and families' traditional core portfolio. But from the CFA Institute point of view, because we look at commercial real estate and different types of real estate investments, it's considered to be a non-traditional asset class, an alternative investment, okay? So point out a few other alternative investments you may have heard about that's not covered in this chapter are hedge funds, or investments of passion, such as art or cars, stamps, wine, what have you. And sometimes we look at different insurance structured products. Currency, sometimes not considered an asset class, but people sometimes do make investments in different currencies as a matter of diversification. And finally, structured products and derivatives is something, we study derivatives, but sometimes there's some structured products combined with derivatives which combine to make a non-traditional product. Okay, so that's just a quick overview. Traditional core portfolio made up of stocks, bonds, and cash. That's the traditional asset class. Non-traditional asset class, moving into alternative investments now, private equity, real estate, and commodities in this chapter. And my second and last slide before we get into the core curriculum. This is a graph from the World Wealth Report. This is a Capgemini. If you Google search Capgemini World Wealth Report, you can find a free copy on the internet. And this is showing the breakdown of high net worth investors' financial assets by region. It's done on a survey. High net worth individuals means investable assets over $1 million, and it's not including the principal residence. That's just a common definition. And so I just want to point out, like I'm here in Canada, which is in North America. You can see that it's much more common for individuals and families to be investing in equities as compared to, for example, the Middle East. So you can see here in North America, the percentage of assets in equities, about 34%. In the Middle East and Africa, 19%. The reason is that as we saw in the chapter on equities, the equity markets in North America are more developed, longer histories than in other parts of the world. So you see a larger portion of assets being invested in these developed equity markets. Okay, so it's just important, depending on your geographical where you're living, that there are differences in how people invest. Okay, so again, investing is converting cash to another asset. Equity investing in the MENA region, for example, is lower than other regions. It has to do with the size, the history, the classification of the markets, frontier, emerging to developed. And finally, you can see that real estate investing in the MENA region is therefore higher. So if we compare it again versus North America, real estate investments 23.3% versus the 12.3%, okay? So that's just one of the things I always like to point out, is that depending on your geographic, where you're based, people have it might have different focus, okay? So again, you can see alternative investments, regardless, if you kind of look at the global averages, 13%. So alternative investments always make up a smaller proportion, but you can see they've got real estate broken out. And then again, as I mentioned, equities, cash and cash equivalents, fixed income, that's your typical core portfolio, traditional asset classes, add on real estate, and then finally alternative investments, what we're looking at today, which is going to add on private equity and commodities, okay? Learning outcome statement A is describe advantages and limitations of alternative investments, okay? So private equity, real estate, and commodities belong to a very diverse asset class called alternative investments. They are alternatives to investing exclusively in traditional asset classes such as equity and debt securities. Although they have gained prominence lately, these investments are not new. In fact, real estate and commodities are among the oldest type of investments. Alternative investments are an opportunity to potentially enhance returns and obtain diversification benefits. Recall from the Quantitative Concepts chapter that diversification is the practice of combining different types of assets or securities in a portfolio to reduce risk. The search for higher returns and lower risk explains why alternative investments are now an integral part of the portfolios of many investors who view private equity, real estate, and/or commodities as opportunities to deliver both. Okay, I started the video by showing a graph about high net worth individuals from the Capgemini World Wealth Report. Well, in this reading, they contain a global survey, but it's on institutional asset allocation. So that's looking at institutional investors. And so you can see the percentage of respondents holding this type of asset. Of course, equities, 98%, fixed income, 99%, cash, 61%. So it's interesting note here that when we look at the alternatives, it's very high. It's at 94% with regards to institutional investors. So investing in alternatives is quite common. And so then it's broken down, the alternatives below here, to private equity, private real estate, public real estate, and commodities. And you can see the share for commodities is quite a bit lower. And that would, you might suspect that typically maybe gold and investing through gold ETFs, which is something you might want to follow up on. Nevertheless, we can see that from an institutional point of view, investing in alternatives is fairly common. The average percentage of the portfolio invests in this type of asset, probably a little bit higher for institutional investors than it is for individuals, because investing in private equity is a little bit more difficult if you're an individual versus an institution. And you can see that, and the reason why the chapter on equities was so important, because you can see very high, the highest percentage of the portfolio is invested in equities, okay, 41% on based on this global survey of institutional investors. Core portfolio, stocks, bonds, and cash, and then looking at alternative investments, pretty good portion, and it's made up of private equity, private real estate, public real estate, and again, commodities, very small percentage. So continuing with the advantages of alternative investments, okay? Investors add alternative investments to their portfolios for two main reasons. One is to enhance returns. Two is to reduce risk by obtaining diversification benefits. In terms of enhancing returns, the graph in the text shows that between 1990 and 2009, investments in private equity and real estate outperformed investments in equities and debt securities. Now, I'm a little bit suspect of that data. I think long-term on average, if you look at a cycle longer than 1990 to 2009, you'll find that equities long-term on average have the best returns. Okay, I think this graph is a little bit wonky, showing that debt has got higher returns than equities from 1990 to 2009. That may be the case. Another thing is you have to look at what data they're using. Okay. Anyhow, I think this is perhaps a little bit out of whack. I think long-term on average, equities have the highest return. maybe followed by private equity, real estate, debt, and then commodities. Okay. Nevertheless, that's the graph that they exhibit to in the text, and but just be aware that that's an important point. You should not conclude that alternative investments always offer higher returns than other asset classes. The global financial crisis started in 2008. Many investors suffered losses on their private equity and real estate investments. And the other thing, as I mentioned, is that you have to look at how are they measuring, what is the index. The measurements for private equity and real estate are a little bit more murky than looking at the returns to equity asset classes. Okay. In terms of reducing risks, remember we looked at in the chapter on quantitative concepts that investors diversify their portfolios by investing in assets and securities that behave differently from each other. And how do we measure that difference in behavior? It's by calculating the correlation coefficient, which is is a value that goes between -1 to 1. Recall, if two assets or securities do not have a correlation of +1, that is, if they are less than perfectly positively correlated, then combining these two assets or securities in a portfolio provides diversification benefits and thus reduces the risk in the portfolio. Because there is a relatively low correlation between different types of alternative investments, and also because alternative investments in other asset classes, adding private equity, real estate, and commodities to portfolios helps investors reduce risk. So again, as noted in the Quantitative Concepts chapter, during periods of financial crisis, returns on different investments may become more correlated and the benefits of diversification may be reduced. There's an expression, a rising tide lifts all boats. Well, it's the same thing in a crisis. A tidal wave hits all boats, okay? So that's just one thing to be aware of. Okay, this is my own slide. It's not in the CFA Institute Investment Foundation's textbook, but as you know, from time to time, I like to bring a little bit more real world into the classroom. So again, this is from the J.P. Morgan Guide to the Markets, data as at September 30th, 2018. And when you first look at this, your eyes may glaze over, but actually it's called a asset class returns, a checkerboard of asset class returns. And once we just walk our way through this fairly quickly, you'll see that it's fairly easy to understand, and it provides some very valuable information. It's kind of building on all the things that we've been learning throughout the chapters. Okay, so first of all, it's looking at asset class returns. What are those assets? Well, if we, and again, the time period that they're looking at is from 2003 to 2017. Okay, and so you can see that if I just go down here, they're looking at the annual compounded returns from 2003 to 2017. We can look at the asset classes. Here we have emerging market equities, and they've got the annualized return, and they've got the volatility as measured by standard deviation. So you can see a lot of things we've been learning have been coming together now. So from 2003 to 2017, emerging market equities had the highest return, and the volatility was 23%. Okay, the next asset class in terms of annual returns was small cap equities, and they had a standard deviation risk of 18.8%. Then we're looking at REITs, which are real estate investment trusts, and that's included in this chapter. So this is why it's good to understand. You could see during that time period returns of 11.1%. Risk of 22.3%. Next asset class that they're looking at is large cap stocks, then high yield bonds, developed market equities, okay, then fixed income, cash, and commodities. So down here, they're telling you, and then also what they do, so you can see, I just want to point out by looking at the colors, you can see the concept of volatility year on year. So if we look at 2003, you can see that small cap equities had a return of 47.3%, but then in 2007 had a negative return. Equities, and that's the chapter that we saw. On equities, that volatility when we were looking at the S&P 500. Again, if we looked at emerging market equities, 2003, very strong return. In 2008, emerging market equities on a calendar year, negative 53%. Developed market equities in a calendar year, negative 43%, but we saw peak to trough was negative 57% for the S&P 500. You recall my graphs. And you can see that, as it said, in times of crisis, all asset classes more or less can get hit. You can see high yield bonds negative, small cap equities negative, commodities negative, large cap stocks negative 37%, REITs negative 37%. In general, 2008 was not a good year. Okay, that was the financial crisis. But then after that, things bounced back strongly. You can see the year after, emerging market equities 79%. So that's the volatility, that we've talking about in terms of different asset class returns. Then you can see here, this is really good because they have a portfolio made up. And then if you look at the volatility, that's why they've done the black line. You can see that the volatility of a portfolio that's made up of a collection of these different asset classes is a lot less volatility than looking at some of the individual asset classes, and that's the power of diversification. Okay, so if we look at, and so here it's in the small print, you can see what they're using in terms of their different indexes. So for the large cap, it is the S&P 500. For the small cap, the index is the Russell 2000. For emerging market equities, it's the MSCI Emerging Market Index. Developed market they're using MSCI Europe, Asia, Far East. For commodities, they're using a Bloomberg Commodity Index. High yield is a Bloomberg Barclays Global High Yield Index. Fixed income is a Bloomberg Barclays U.S. Aggregate Index. For REITs, they're using a North America REITs Equity REIT Index. And so the asset allocation portfolio assumes the following weights: 25% in the S&P 500, 10% in the Russell 2000, 15% in the MSCI Europe, Asia, and Far East, and 5% in the MSCI Emerging Market Index. Let's just bring up the calculator and show how much that is in terms of equities. Okay, so you can see I've added up all the equities, and this portfolio is made up of 55% in equities, and that's not uncommon, okay? And then we move on, 25% in the Bloomberg Barclays U.S. Aggregate, that's bonds, 5% in the 1 to 3 treasuries, that's short-term cash, and then 5% in the high-yield bonds, 5% in the commodity index, and 5% in the Real Estate Investment Trust Index. So that's about right. 5% in commodities, 5% in real estate. Okay, so that's quite an interesting thing to be able to understand. Just get rid of my calculator here. So again, J.P. Morgan Guide to the Markets as at September 30th. Nice little graph in terms of asset class returns. Gives you the years from 2003 to 2007, individual annual calendar year returns for the asset classes. By looking at the colors, you can see a lot of volatility. Looking at small cap stocks, for example, you can pick out a very bad year, 2008. You can look at the annual compounded annual returns from 2003 to 2017. And also looking at the volatility as measured by standard deviation for that time. And then finally, you can look at a portfolio and look at what the returns on that portfolio would have been on an annual basis. And here it is from 2003 to 2017. If you follow that, if you had that asset allocation, you would have had a return of about 8.3% and 11% in terms of the volatility, which is a lot less than having all your eggs in one asset class basket, okay? And this is my own slide again, and we looked at it in the Quantitative Concepts chapter. Again, it's from the J.P. Morgan Guide to the Markets as at September 30th, 2018. So here we're looking at this U.S. large cap. We know that's the S&P 500. This is the MSCI Europe, Asia, Far East. This is the MSCI Emerging Market Equities. And then again, it's looking at the asset classes that we saw on the previous checkerboard of asset class returns, okay? But what this is and also this is looking for the period, a little bit different period because this is 10-year, okay? So it's looking from September the 30th, 2008 to September 30th, 2018. And so this is looking at the correlations in volatility. So again, there's the annual volatility, but here's the correlation. So we're looking for correlations of less than 1 are going to add portfolio diversification benefits. So if we just go across this first line, you can see that the S&P 500, MSCI, Europe, Asia, Far East, well, that's equities to equities. It's still less than 1, but that's a fairly high correlation, as you would expect. Emerging market equities at 0.8. And again, that's the interesting one to see, is that there's actually negative correlation between U.S. large cap stocks, the S&P 500, and the bonds, okay? If we look in municipal bonds as well, currency. But if we look here at the REITs, fairly high correlation, because real estate, even though the asset class is real estate and real estate investment trusts, we're going to see later in the chapter that real estate investment trusts are traded on stock markets. So you often, not often, but you see a very high correlation fairly high correlation between REITs and large cap stocks, okay? And here we can see fairly high correlation between the hedge funds and the private equity in stocks as well. But again, it is less than 1, which does provide diversification benefits. So we looked at some of the advantages of alternative investments, and now we're going to discuss a couple of the limitations, okay? So although alternative investments have the potential to enhance returns and reduce risk, they also have limitations. Because alternative investments are less regulated and less transparent than traditional investments, such as equity and debt securities, individual investors are less likely to invest in them. Institutional investors may view this as an opportunity to take advantage of market inefficiencies. In addition, most alternative investments are illiquid. That is, they are difficult to sell quickly without accepting a lower price. So these are some of the issues: less regulated, less transparent, and less liquid, okay? So for example, it's much easier to sell shares of a public company listed on a stock exchange than shares in a private company, a piece of land, or a building. Some institutional investors, depending on their cash flow needs, may be willing and able to hold investments for long periods. If we look at pension funds, they've got very long time horizons, okay? So do sovereign wealth funds, very long time horizons. So liquidity may be less important for them than for individuals or institutional investors that have liquidity constraints. Alternative investments are also difficult to value because data availability to assess how much they are worth are limited. And that's one of the things that I pointed out for that chart. Looking at that data, you need to be a little bit suspect of where that data is coming from, okay? So purchases and sales of startup companies, land, or buildings are infrequent, so valuation is challenging, and it's often also based on an appraisal. Learning outcome statement B is describe private equity investments. Private equity firms invest in private companies that are not publicly traded on a stock exchange. Although people commonly refer to private equity, investments include both and equity and debt securities, so that's something to be aware of. Debt investments, however, are less common than equity investments. So a term here, venture capital, is a private equity investment strategy that consists of financing the very early stage of companies that have an innovative business idea. Venture capitalists frequently invest in startup companies that exist merely as an idea or a business plan. The company may have only a few employees, have little or no revenue, and still be developing its product or business model. Entrepreneurs are often looking not only for capital to start their business, but also for advice and expertise about how to establish and run their company. Venture capital is considered the riskiest type of private equity investment strategy because many more companies fail than succeed. It can take many years before a company becomes successful, and most venture capital funded companies have years of unprofitable activity before they reach the point of making money. That's why if we look at private equity firms and we look at their venture capital investments, they're looking to make a portfolio, just like diversification in terms of their venture capital investments. Because if you looked at, they invested in 100 companies, at least half are going to fail, okay? Then another 25% will run at a loss, but it'll be a small batch, 25% or 25 of those companies that will cover all the other losses. They'll become very successful. And that's why private equity companies have to invest, diversify their investments and make more than an investment in one company. So continuing with private equity investments and private equity strategies, now we're going to look at growth equity and buyouts. Okay, so growth equity is a private equity investment strategy that usually focuses on financing companies with proven business models, good customer bases, and positive cash flow or profits. So these are companies that have grown up from the venture capital stage and are now actual businesses, and they're growing, but they need more equity to grow, and this is what we refer to as growth equity. Okay, so these companies often have opportunities to grow by adding new production facilities or by making acquisitions, but they do not generate sufficient cash flows from their operations to support their growth plans. Some growth equity investors specialize in helping companies prepare for an initial public offering, an IPO. These investors provide additional money at a later stage of a company's development than venture capitalists or early stage growth equity investors. Okay, so initial public offerings such as those of Microsoft, Google, and Facebook is an opportunity for the founders and existing shareholders to convert some or all of their investment in the company into cash. That's their exit strategy for a lot of investment early investors. Once they do the IPO, that's their exit. They can sell their shares on the public markets. Moving on to buyouts. Buyouts are a private equity investment strategy that consists of financing established companies that require money to restructure and facilitate a change of ownership. Buyout transactions sometimes involve making a publicly traded company private. Buyouts for which the financing of the transaction involves a high proportion of debt are often called leveraged buyouts. Buyout investors often target companies that have recently underperformed, but that offer opportunities to grow revenues and margins. And also there might be an opportunity to break up the company where there'll be a higher value derived from the breakup than from the individual company. And we looked at that in terms of a spin-off. So, which is somewhat closely related to sometimes a buyout situation as well. The company leveraged buyout, or the company is taken from public to private, and then different parts of the company are sold off or spin off. Okay. So again, continuing with private equity strategies, now we're moving on to distressed investing and secondaries. Distressed investing is when companies encounter financial troubles. They may be at risk of not being able to make full and timely payments of interest and or principal. Distressed investing focuses on purchasing the debt of troubled companies that may have defaulted or on the brink of defaulting. Frequently, investments are made at a significant discount to par value, that is, the amount of money owed to the lenders at maturity. If the company can survive and prosper, the value of its debt will increase and investors will realize significant value. Distressed investing does not typically involve a cash flow to the company. Okay, this is buying the outstanding debt of companies that are distressed and hoping that they work through it and eventually pay back that principal. Okay, and so the debt is sold at a very high discount. And when it matures at par and they get paid back, that can provide significant returns. Okay. Secondaries is another kind of strategy that does not involve cash flow to the company. They are not based on a company's stage of development, but involve buying or selling existing private equity investments. The life of a private equity fund is about 10 years, but it can be longer. Some private equity partnerships may not be able or willing to hold onto all of their investments, which could be venture capital, growth equity, buyouts, or distressed. So a partnership may want to sell one or several of its investments to another private equity partnership in what is known as the secondary market. So we call that secondaries, secondary market. That's the buying and selling of some assets held within certain private equity partnership structures. On this slide, we're looking at the structure and mechanics of a private equity partnership, and I would say this is a very important slide. There's quite a bit of terminology on this slide, and quite a few questions in the learning ecosystem are based on this slide, and you would suspect that perhaps there'll be one or two questions on the exam with regards to private equity. Okay, so let's go through this, and it's not that difficult, but we just need to work our way through it. So we'll start here. Private equity investments are usually organized in funds managed by partnerships and usually include two types of partners. Okay, so the first we're going to look at here, the general partner. The general partner is typically a private equity firm that sets up the partnership. It is responsible for raising capital, finding suitable investments. Okay, so you can see here the general partner is responsible for finding investments. Company Y, Company X, this could be venture capital or growth capital, but it's the private equity firm that's looking to place the money, make the venture capital investment, so for example. Okay, it's important to understand that general partners have unlimited personal liability for all the debts of the partnership. That is, general partners could lose more than their investment in the partnership because, if necessary, their personal assets could be used to pay partnership debts. Okay, it's not a corporation with limited liability. That's why you have limited partners over here, limited partner A, B, C, D. Limited partners are investors who contribute capital to the partnership. They are not involved in the selection and management of the investments. Okay, limited partners have limited personal liability. That is, limited partners cannot lose more than the amount of capital that they contribute to the partnership. So you can see here the limited partners have what's called the capital calls. They're providing the capital to the private equity firm, the general partners, but it's with a limited liability. Okay, they also pay management fees. And it's important to understand that management fees are paid on capital committed, not invested capital. And of course, they're making investments to a private equity firm. The firm makes investments in the various companies, and these realizations is, money coming back to the private equity firm, either through dividends or the company's being initial public offerings, all the exit strategies that can generate cash from these investments back to the private equity firm. And then of course there'd be cash distributions over to the the limited partners. Okay, so the private equity firm makes money through two different mechanisms. Number one are management fees. Management fees are the fees that the limited partners must pay general partners to compensate them for managing the private equity investments. So that's a little bit like a salary. Okay, management fees are like a salary. So private equity firms receive management fees from the limited partners. Okay, and then there's the carried interest. Okay, this is a very important term, and I put it right into the slide. Carried interest is a share of the profit on a private equity investment. It is a form of incentive fee that general partners deduct before distributing to the limited partners the profit made on investments. So you can see the money comes in from limited partners. General partners also provide their own funds to the private equity firm. That gets invested in a number of different companies, different stages of growth. Then there's different exit strategies, which brings cash back to the private equity firm. And then the carried interest is the share of the profits that the private equity firm keeps before the cash distributions are made to the limited partners. Okay, and you can see here, if there's a fund manager, if the private equity investments are being done through a fund, then sometimes there's also fixed fees or incentive fees. Okay. So finally, the last thing that we'll point out is that investments in private equity partnerships tend to be illiquid, not very liquid. That is, once the limited partners have committed capital to the partnership, it is difficult, if not impossible, for them to exit the investment before the end of the commitment term. So we'll just do a quick practice question from the learning ecosystem. This is classified expert. In the area of private equity investing, carried interest is A, the interest paid on committed capital, B, the management fees paid by the limited partner, or C, the share of profits retained by the general partner. You can see the correct answer is C. In the area of private equity investing, carried interest is the share of profits retained by the general partner. Carried interest is the share of profits that the general partner retains before returning capital to the limited partner. Okay, this slide is looking at the J-curve, and the J-curve is following this line here, and you can see it's somewhat shaped like a J, so they're calling it the J-curve. And what is the J-curve? That line is the cumulative, that's an important word, cumulative net cash flow to the limited partner. That's to the limited partner. I put that in bold and green. That is the sum of the cash distributions minus the sum of capital calls and management fees. So on the y-axis here, it's in dollars thousands, okay? And on the x-axis, it's in terms of time. So you can see in the early years, the limited partners are putting cash into the general partnership. It's a negative cash flow, okay? That's the investment. And that's through capital calls and management fees. Then as the general partner makes investments, venture capital, growth capital, etc., and as time goes on and the various exit strategies start to be realized, selling the companies or doing IPOs, etc., the cash starts to come into the general partner, the carried interest is deducted, the distributions are made to the limited partners, and the cash flow hopefully becomes positive in the later years. So this curve is showing, you see here on the y-axis, the cumulative. So negative cash flows in year one, negative cash flows in year two, and so we're following the negative cash flows until they start at year 5 or 6 to start becoming positive. We break even here in terms of cash flow in somewhere like 8.5 years, and then after that the cash flow is being positive. So what did we learn in the quantitative chapters? Well, we can do certain calculations in terms of net present value, okay? Net present value is the sum of the present value of the future cash flows, okay? So you can see there's cash going out and then there's cash coming in. We can calculate the net present value, and if it's positive, then it's using a certain discount rate. Remember, we have to determine what discount rate. If this is fairly risky, we might be looking at discount rates of 15%, 16%, 17%, 18%. If it's positive, then it's a good investment. Now, the difficulty is, especially when you're looking at venture capital or private equity, it's very difficult to forecast these the amount and timing of these positive cash flows because you're sometimes dealing with startup companies, okay? But anyhow, the J-curve is not too hard to understand. It's the cumulative net cash flow to the limited partner, the sum of the distributions minus the sum of the capital calls and management fees. So negative in the early years, hopefully positive in the later years. Quick practice question to check our understanding from the learning ecosystem classified as difficult. In the private equity realm, the J-curve refers to the pattern of A, carried interest received by the limited partners, or B, cumulative net cash flows to the limited partners, or C, drawdown in capital committed by the limited partners. And the correct answer is B. In the private equity realm, the J-curve refers to the pattern of cumulative net cash flows to the limited partners. So the two important words, cumulative and limited partners, three important words. So B is correct. The J-curve refers to the pattern of cumulative net cash flows, distributions minus capital calls received by the limited partners. Carried interest, remember, is the share of profit that accrues to the general partner. So A is obviously wrong, okay? So now we're moving on to learning outcome statement C, which is describe real estate investments, okay? And real estate investments take different forms. For many people, it is the purchase of their home, which may be a significant portion of their net worth. Houses, apartments, and other residential properties that are owner-occupied are indeed the foundation of many individuals' financial plans. And I showed you that depending on different parts of the world, real estate has a bigger role in the Middle East than it does in North America, okay? However, although considered part of the financial plan, most residential real estate is not included in investment portfolios. And that's what I told you. The Capgemini World Wealth Report, when we look at the classification for high net worth individuals, those are individuals that have $1 million in investable assets. It does not include their home, their principal residence. Okay, this slide is an interesting one. It's looking at the country concentrations of commercial real estate. And you can see that the value of commercial real estate is more or less concentrated in developed countries with the exception of China, okay? And the way to interpret this, remember in the chapter that we looked at in terms of equities, we looked at the global framework for equity markets, and that's as measured by market capitalization. And so the framework that we looked at was the frontier markets, the emerging markets, and the developed markets. And we're looking at the MSCI. I'll forget about the frontier markets, but we're looking at the MSCI All Country World Index. And that All Country World Index was made up of the MSCI World Index, which was developed markets, and the MSCI Emerging Market Index, okay? And remember, if we looked at that, if we looked at this index at the level here, MSCI All Country World Index, made up of the MSCI World Index, emerging markets, and the World Index is the developed markets. Well, if we looked at the concentration in terms of by market capitalization, recall that the U.S. was about 55%, okay? So, in terms of equities, the U.S. market clearly dominant in the world. And also here, if we look in terms of the country concentrations in terms of commercial real estate, USA is also in a number one spot, okay? That's the, when you understand the size and importance of the U.S. in financial markets, you start to appreciate it by looking at first the equity markets. Now we're looking at commercial real estate, quite important. Now we're moving on to look at different commercial real estate segments and some of the characteristics of those segments. So on this slide, we're looking at land, offices, and multifamily residential dwellings, okay? So land, undeveloped or raw land, can be highly speculative because there are no cash inflows from tenants or occupants, only cash outflows in the form of real estate taxes and other costs of holding the land. So it would be considered to be the most speculative, okay? As improvements are made, such as obtaining building permits and installing roads, utilities, and other services, the land becomes more developed and its value rises based on a projected stream of future cash flows. Investing in undeveloped land is risky because values can decrease rapidly when housing demand falls. Moving on to offices, offices represent one of the largest segments of commercial real estate. They are usually owned by real estate investment companies that lease space to tenants in varying terms, from short-term monthly leases to longer multi-year leases. All you need to do is look at, if you want to see a recent trend in the real world, Google search WeWork and look at what their ownership of commercial real estate is in the major cities in the U.S. and throughout North America and other parts of the world, okay? Because tenants are responsible for paying their leases, whether they occupy the space or not, the income associated with office rents is relatively predictable over the life of the lease. And finally, on this slide, looking at multifamily residential dwellings, also known as apartments or flats, multifamily residential dwellings represent a significant portion of the investable commercial real estate market. These units are rented to individuals or families. Most leases tend to be for periods of 1 year or less, so the multifamily residential dwelling segment is sensitive to supply and demand dynamics in the local marketplace. And this slide is looking at commercial real estate segments, looking at retail properties, industrial properties, hotels, and finally other segments. So retail properties, assets such as shopping malls, commercial shopping centers, and other buildings designed for retail purposes. That's a commercial real estate with a bit of a specialization, retail properties. Industrial is looking at such properties such as manufacturing facilities, research and development space, and warehouse and distribution space. In some countries, they have free zones, which would fall under commercial industrial real estate, okay? Hotels, I think everyone knows what a hotel is, branded short-term stay facilities and longer stay facilities catering to contract workers in remote locations, as well as boutique and independent facilities. And finally, other segments, for example, senior housing is a big thing that's growing in North America. Real estate investment trusts looking at, specializing in senior housing. and that's designed for people aged 55 and above. And also in some markets, there's a specialization in terms of student housing for post-secondary education. Real estate companies are setting up and running student housing as a form of real estate investment. Okay, this is an important slide to understand because we're looking at different types of real estate investment vehicles. So you can see we're going to be looking a little bit more detail at real estate investment trust, real estate limited partnerships, and real estate equity funds. So firstly, investors who have sufficient funds can buy real estate directly. I can go out with, and buy perhaps a apartment building on my own. Otherwise, though, you can gain, investors can gain exposure to real estate through either the private or the public market. In terms of private market investments, the first one that we'll look at is the real estate limited partnership. And real estate limited partnerships are partnerships that specialize in real estate investments and are similar to the private equity partnerships. The general partner raises capital from investors who become the real estate limited partnerships limited partners. And if the general partner is a real estate development firm, it may also manage the real estate projects. Investments in real estate limited partnerships are illiquid, okay? Real estate equity funds typically hold investments in hundreds of commercial properties. These properties are diversified by geography, property type, and vintage year. That is the year the purchase was made. Real estate equity funds are often open-ended funds, meaning that they issue or redeem shares when investors want to buy or sell. Like a mutual fund, if it's open-ended, it means that the fund can continually issue new shares or redeem shares when the investors want to buy or sell. Okay, so a private equity real estate fund would be somewhat similar. It's also important to understand that a real estate equity fund would be larger in size than a real estate limited partnership. Okay, so real estate equity funds are in theory more liquid than real estate limited partnerships. Looking now at public market investments, these are investments made through the public markets, and real estate investment trusts, like other securities, the share of REITs are traded on stock exchanges, which make them more liquid than real estate limited partnerships and real estate equity funds. And as we saw, because real estate investment trusts, REITs, are listed on stock exchanges, their correlation to large cap stocks or the S&P 500 is fairly high, close to 90%, okay, 0.9. So we're just going to do two quick questions from the learning ecosystem to help check our understanding on real estate. The first one is classified difficult. A private market investment vehicle holding hundreds of commercial properties that are diversified by geography, property type, and vintage year is best described as a real estate A, equity fund, B, investment trust, or C, limited partnership. Okay, the correct answer is A. A private market investment vehicle holding hundreds of commercial properties that are diversified by geography, property type, and vintage year is best described as a real estate equity fund. Okay, B is incorrect. Remember, a real estate investment trust is an investment through public rather than private markets. A real estate investment trust is a company that mainly owns and in most cases operates income-producing real estate, and REITs are traded on stock exchanges. Okay, by now I think you should be well familiar with that. And so this is the subtlety here. You can see in the question I put in green, the key word is private. REITs are public investments. Okay, so if B is wrong for sure. But both equity funds and limited partnerships, they're both private. However, the equity funds are typically larger, holding hundreds of commercial properties, diversified by geography, etc. So it's important to understand here, that's why I put it in, that the limited partnership is also a private market investment vehicle that typically, but it typically focuses on a smaller number of commercial properties, such as the construction of a housing subdivision or an apartment complex. So that's an important difference between an real estate and equity fund and a real estate limited partnership. And one last question regarding real estate from the learning ecosystem, again classified as a difficult. In which type of real estate investment does the investor supply capital to a general partner who then invests the capital? A, a real estate equity fund, B, a real estate investment trust, or C, a real estate limited partnership? Hopefully you didn't find that too difficult. Of course, we're doing the questions right after reviewing the material, so it seems easy. Just wanted to point out that as you go through your studies, you go through the questions in the learning ecosystem, it's always important to go back and then do some reviewing. And that's one of the reasons why I like the learning ecosystem. You can go back and review all the questions that you've done. You can reset the chapter, etc., do them again. Anyhow, because right now this doesn't seem too difficult at this stage, but 2 months from now, it's easy to start to forget things. Anyhow, that's my little exam tip as well. So in which type of real estate investment does the investor supply capital to a general partner who then invests the capital? Well, that's a real estate limited partnership. A real estate limited partnership is structured like a private equity partnership in which the investor is the limited partner that supplies capital to the general partner who then invests the money in real estate projects. So A is incorrect. Real estate equity funds are open-ended funds that issue or redeem funds when the investors wish to buy into the fund or sell out of it. And B is incorrect because real estate investment trusts are closed-end funds that trade on major exchanges, stock exchanges, much like equities stocks. Learning outcome statement D is describe commodity investments. And as we saw from previous slides, commodities really make up a fairly small percentage of any institutional portfolio, down at like 1%, although many institutional investors do invest in commodities. And for individuals, there's a big interest in gold all around the world, and you'd have to include that as a commodity investment, okay? When we look at commodities such as precious and base metals, energy products, and agricultural products, the prices tend to rise with inflation, so they can provide inflation protection in a portfolio. Okay, so that's one of the drivers for the the investment. Just a quick thing here on the topic of gold. If you Google search Coolidge Times gold Ted Stevenson, you can see that over the past year and a half or so, I've had some contributions to the Coolidge Times in the Middle East on articles regarding gold. So you can see November the 25th, 2017, I made a comment, and this is just general investment advice, that the common investment advice is that gold could or should be between 5 and 10% of an investment portfolio. The reason is because there are some benefits of diversification. It's all the stated reasons. When there's geopolitical trouble and a flight to quality, money flows into gold. You can see the article at the end of 2017 said gold will shine far brighter in 2018. In fact, gold did not shine far brighter in 2018. It was on a downward trend all the way to August, and then it's been bouncing back since then. And gold ended on a negative year for 2018. But the comment that I made, CFA type comment, is that there's simply too many inputs into any model that would correctly forecast the performance of gold in 2018. So I look pretty smart there. Anyhow, moving to 2018, December 30th, 2018, less than a month ago, should you go for gold in 2019 now? And all I said there, if we just click on that article, so here we are, the Coolidge Times, scroll down, this 30% are sad because the price of gold went down in 2018. But so if we just scroll down the article, there's my picture. So I just said that since mid-August, gold has been on a rising trend, and the factors contributing that trend are maybe likely to continue. Okay, Professor George Brown. Here I am, Ted Stevenson, Professor George Brown College in Toronto, said since mid-August, gold has been on a rising trend. Factors are likely to continue. Gold will act as a flight to safety asset if stock markets continue to weaken and financial market uncertainty remains. Okay, geopolitical factors, the chance for larger stock market correction, and a Federal Reserve policy that could keep the U.S. dollar from further strengthening could all contribute to a strengthening in the price of gold. If the U.S. dollar is getting stronger, gold price gets weaker. If the U.S. dollar starts to weaken, you'll see the gold price will go up. Okay, so that's my last little bit here, input on gold. So this is the last slide for this topic in this chapter. It's gaining exposure to commodities. So it's looking at 3 different ways. Number 1 is the purchase of the physical commodity. Again, if we're looking at gold, there's a lot of different ways of participating in gold around the world. In China and India, they buy gold jewelry. That's where major demand for gold comes from in terms of jewelry. But there's also investments through gold exchange-traded funds, and that's another big driver. Central banks are big buyers of gold. Technology producers have a use for gold. So there's different things that drive the demand for gold, and there's different ways of gaining exposure to it, okay? So if we just stick with the gold. So number one is you can purchase the physical commodity. Theoretically, but when we look at different commodities like oil, theoretically an investor could buy a barrel of oil or a head of cattle or a bushel of wheat, but transportation, storage difficulties associated with purchasing a physical commodity mean that, other than gold, it's really rare for investors to gain access to commodities in this way. So we could look at the purchase of shares of natural resources or commodity-related companies. So again, you can buy shares in gold companies, which is a huge part of the Canadian economy. Canadian gold companies globally are quite large. Commodity-related companies involved in oil and gas, for example. So yeah, investors can buy shares of companies that have a major portion of their operations in the exploration, recovery, production, and processing of commodities, nickel, copper, gold. For example, an investor who wants exposure to oil may buy shares in a major oil company such as BP, ExxonMobil, Petrobras, PetroChina, Statoil, or Total. Okay, and finally, the purchase use of commodity derivatives. As mentioned in the derivatives chapter, investors can buy derivatives in which the underlying asset is a commodity or commodity index, and typical commodity derivatives are forwards, futures, options, and swaps. But you can understand that in all forwards, futures, options, and swaps, that there's they're not infinite investments. They're not long-term investments. There's a expiration date on futures. So it's much more speculative when you get into purchasing commodity derivatives. Buying futures in gold is really more of a speculative nature than buying a gold ETF that you can buy and hold, or buying the physical gold and perhaps keeping it in a safety deposit box. Okay. Anyhow, that's the last slide for this chapter. It was with regards to gaining exposures to commodities, and that's the last slide for this topic. And that is the conclusion for this video, which was Module 4, Investment Instruments. The last chapter for that module, Chapter 12, on Alternative Investments, for the CFA Institute Investment Foundations Program. Thank you.